Michael Drozd, Chief Investment Officer for LaSalle Street. This is a view from the street, our market and economic recap for the month of November. Let's go ahead and jump right in. In November, the S&P 500 had its best month of the year, rising 5.7%. Small cap stocks also outperformed U.S. large cap stocks, with the Russell 2000 surging over 10%. The Nasdaq Composite also saw significant gains, closing at a new record high. However, the MSCI IEFA index, which tracks developed markets outside the US and Canada, fell by 5.5%. Similarly, the MSCI Emerging Markets Index declined by 4.3%, with emerging Asia particularly affected by the strong US dollar. Turning to the bond market, the Bloomberg US Aggregate Bond Index rose by roughly 1%, fueled by hopes for further rate cuts and prospects of budgetary efficiency as a result of the incoming Trump administration. U.S. high-yield bonds also performed well, returning nearly 1.15% for the month and bringing the year-to-date performance to over 8.7%. Despite the bond market's post-election march higher in yields, the 10-year yield ended the month modestly lower, near 4.4%. This drop in yields also highlights the interconnectedness of global bond markets. While U.S. growth fuels optimism, international factors also shape market trends and investor sentiment. Issues like budgetary constraints, geopolitical tensions, and increased trade protectionism create high uncertainty about the global economy. These factors affect global economic imbalances and the demand for U.S. financial assets, specifically U.S. Treasuries, which have historically been seen as a safe haven asset, ultimately pushing yields lower in the process, at least temporarily. Fed Chair Powell's commitment to further normalizing policy, although recently mildly downgrading the labor component to his dual mandate, along with the anticipated spend down of roughly $700 billion in the Treasury General Account early next year, positions risk assets in a favorable manner. As long as political brinkmanship doesn't derail the debt ceiling moratorium, the outlook remains positive for risk assets. Investors should welcome further policy easing and direction on the debt ceiling moratorium as we head into the new year. The imposition of broad-based tariffs is anticipated to elevate near-term inflation and potentially dampen economic growth temporarily. Fixed income and currency markets have already responded to this uncertainty, visibly in higher 10-year Treasury yields and a strong US dollar. For now, these upside surprises to inflation may be dismissed by asset markets as growth remains resilient and the Fed attempts to find its new neutral rate. Stricter immigration policies may not be as inflationary as commonly perceived. A labor force shock impacts both supply and demand simultaneously. However, the demand shock might be mitigated if immigrant workers are predominantly in lower income tax brackets. However, an extension of the Tax Cuts and Jobs Act and additional pro-cyclical tax cuts may offset stricter immigration policies. Regardless of these outcomes, higher fiscal deficits are anticipated, especially as entitlement spending due to demographic shifts in the U.S. and defense spending are all anticipated to rise in the future. Asset markets may struggle amid uncertainty regarding the sequence of the second Trump administration's policy implementation. Negative impacts from tariffs and immigration policy may occur before the positive impacts of tax cuts, deregulation, and increased energy production. Currently, the most important policy to focus on is the expiring debt ceiling moratorium on January 1st of 2025. An extension would delay $750 billion of Treasury General Account reduction, rattling risk assets in the process. Additionally, the new Treasury Secretary, Scott Bessent, may shift financing from short-term bills to longer maturities, potentially disrupting the bond market in the process. U.S. equities currently have a more favorable backdrop compared to international equities. Near-term risks include U.S. dollar strength and budgetary issues in major European economies. However, long-term investors might benefit if the U.S. dollar strength reverses, leading to more accommodative monetary policy in the Eurozone and emerging markets. Within fixed income, we prefer shorter and intermediate maturities due to their historically attractive yields. We remain underweight in long-duration bonds because of their greater sensitivity to growth and inflation dynamics, possible increased fiscal deficits, and central bank policy normalization. In conclusion, the near-term outlook for risk assets remains positive. However, the second Trump administration and the impacts of policy implementation are still an unknown risk to markets. Thank you for tuning in. Be sure to stay tuned for our next market update.